Hi guys, welcome to Let's Talk. I'm Akim and I'm with my co-host Demetri. And today we have a very special guest. It's fund manager Zech. He's an elite pro popular investor. That's his username. His real name is Zheng Bin. I hope I pronounced it correctly. And today we will discuss his strategy. We will discuss his portfolio, but we will also have a broader discussion on macro topics. I'm sure it will be really, really interesting. And of course, we have to touch base on the China stimulus package that was announced recently. A big portion of Zach's portfolio is is exposed to China or to Chinese companies, but not only. It's quite an exotic portfolio actually. And Zach, maybe you want to introduce yourself a little bit, just a few words about what you do in your life and maybe how you ended up deciding to invest on eToro. Was your goal to become a popular investor as soon as you registered? Just a little bit of, a few words about you.
Okay, so I'll tell the story. I'll start from the beginning. So when I started eToro was actually because at the time my father had just passed away and I was very close to my family. And one of the things my dad said to me is, can you help your mom look after money? Because I studied finance. I was doing my master's at the time and I did my undergrad in accounting. And I've always loved markets. I traded my way through uni. So I know markets a little bit as a kind of a uni student, studied topics. And what happened was when I went out into the world to work and tried to help my mom manage money, I realized there's a big difference between the way accredited investors invest and the way regular retail investors invest. So that's the legal definition, accredited and retail investors. There are many reasons for that, but I found it an uneven playing field, and I hate being bullied. Number one thing I hate is I don't like being bullied, and number two, I don't like being preyed upon. And so I found it quite gross. I joined eToro because I saw that, there's an opportunity here to help people by showing them exactly what's in your portfolio, by showing them you cannot lie about your performance. I think that's a huge aspect. And that's when I started. So this was 8 years ago, and I joined the PI program shortly after. Initially, my username FundManagerZech was because I wanted to copy people. I did not want to trade myself. And the reason for that is you don't have time. When you start work, you have like freaking so many things to do. The last thing you want to do is like during your lunch break, open up your portfolio and check. It doesn't not make sense. So I tried to copy people, but what I found was it was difficult. And at that time, eToro was also a different animal. You have to remember, crypto was crazy. Risk score was really a suggestion. It wasn't a necessary thing. So when you see a lot of PIs, especially the ones who've been around, and returns are very high back in those days, it's because it was a different game. We were given in extra credits as well to trade on the platform, and that helped buffer your risk score. So there were so many things going on that made it a completely different game. But long story short is, at the end of the day, I wanted to help, again, the retail investors or regular people invest their money and do it in a transparent and honest way. So then came the question of, okay, how do you do it? Because, and this is the actually fun part, and I wanted to talk to Akim about this, is I saw your LinkedIn profile, I know kind of what you do. And the way or the facilities that we have on as a retail investor is completely different from a fund. You would agree?
No, absolutely. It's very different. So you started as a copier, and what made you want then to become a popular investor? You said you mentioned the word trust, right? So
Yes.
did you have a bad experience with the popular investor you were copying and you wanted to come up with something new, or?
Oh yeah. So what I did was I started a demo account and I started copying 5 people. I did all these like fancy covariance metrics, and we did the what's that? Efficient frontier. That's what we call it in finance, right? Efficient frontier, reduce the risk and all that. I did all the modeling, and I tried it for 3 months, and 2 of them blew up, went to zero.
Mm.
Yeah, when I tell you eToro was a different game back then, it was really a different game. Like you could go to zero in like 2 months. Perfect performance for like, don't know, 12 months, and then suddenly you just blow up. So yeah, the reason why I started was like, yeah, I can't copy these guys, so I decided to try it on my own.
Mm. Interesting.
Interesting.
Quite interesting.
Yeah.
And so you then you mentioned some models that you tried
Mhm.
on the demo account. Are you more of a mathematical trader then, or how would you define yourself? Or what do you use for
Yeah.
your asset selection? Because when I
Mm.
have a look at
Yeah.
your portfolio, there's a little. It's I mentioned it
Yeah.
before our call. It's quite exotic, and I
Yeah.
want to understand it a little bit better.
Mm.
There's some Chinese railway stocks, some
Yeah.
Chinese building stocks,
Yeah.
Alibaba. There is also a company that is very well known in Luxembourg, is your third biggest position. Tenaris is headquartered here
Oh,
in
is it well
Luxembourg.
known?
I mean, it's
I didn't
headquartered
know
in
it's well known.
Luxembourg. It's
Oh
well
yeah.
known in Luxembourg. So I mean,
Okay.
people who live in Luxembourg,
Mhm.
they've seen their offices.
I see.
Um,
Okay.
there is Ether, the crypto Ether. You have a crypto miner, US crypto miner, Riot Platforms.
I should
So
have two actually.
you have also Porsche. So there's
Yeah.
really a little bit of everything. And uranium
Mhm.
ETF, a little bit of everything from really all over the world.
Yep.
I mean, this is a perfect example of diversification, but I don't know if that is really your goal, is to diversify through geographies and sectors,
Mm.
or how do you select actually those assets? Because this is
Mm.
really difficult to understand by looking at the portfolio, which has been
Yep.
performing incredibly well. You have 9 years of trading history. Is your benchmark the S&P, by the way? If it is, you outperformed the S&P 500. I don't know if you have a specific benchmark or if you
Mhm.
seek absolute returns. So there's like a double question there.
Okay. Well, for one, I don't believe in benchmarks. Not because of any reason other than why do you benchmark? If you ask a regular investor, retail investor, why do you benchmark? They would say, oh, I would choose between you and an S&P 500 fund. But that comes with its own risk, right? Because you're risking the performance of the S&P. If you say you're an absolute return investor, is that the right benchmark as well? Because we look at absolute return ETFs, they tend to be heavily in bonds. So I don't believe in benchmarks. I believe in convexity and risk asymmetries. So yeah, again, I believe the audience is more PIs, and so this is a topic I'd like to touch on, is what I'm looking for every time I invest is what potential trades do you have that have limited downside and maximum upside. So if you're wrong, you lose a little bit. If you're right, you win a lot. Now, I'll give you a simple example. I've executed all three trades, and one is active at the moment. So I don't like talking about styles because I'm not fixed in a style. I'll start this example. So I trade Bitcoin. Right? I love Bitcoin. I work in crypto fund and I have access to a lot of information, all that stuff. But when I trade on eToro, it's completely different. So the first time I traded crypto or Bitcoin, it was because of technical analysis. And this, Akim Demetris, you guys are familiar with. You look at the chart, support resistance line, you choose a target area and all that nonsense, and it goes from there. Second time I traded Bitcoin, it was using the Grayscale Bitcoin ETF. And the reason for that is because it's trading at discount to net asset value. And the reason for that is a bunch of regulations in the US, which I believe would have been resolved. So if you're correct and Bitcoin goes up and the legal problems get resolved, then you get a double return from them. The third is the one that we have right now, crypto miners. The reason why I buy crypto miners is there's some activity in the private equity space, and there was a JP Morgan report that came out that said these guys are buying into crypto miners for the reason that infrastructure is very difficult to build for that kind of capacity. And a lot of these private equity firms are looking at it as, if Bitcoin doesn't do well, I can take it down and replace it with AI servers, and that infrastructure will serve that purpose. So now what I've done is I have a view on Bitcoin for all 3 times, but I've limited my downside using different methods. And that's what I believe is our greatest advantage when we say that, we're trading on eToro, because if you are a fund and you're an institution or whatever, you are limited by a mandate. On eToro, we have the flexibility of switching between strategies and finding the maximum upside and minimum downside or convexity, as I mentioned. It's not an easy strategy. It's very, very complex. There are many things you can do. But if you explore the universe and you always look out for convex returns, then you can find a huge advantage. And I believe that that's our biggest advantage in eToro.
Interesting.
It's very complicated. I'm sorry, but yeah, I really believe that's the case.
No, it's fascinating because when we got in touch and we start talking, then the first thing I do when I meet someone, a fellow investor, just look at the portfolio.
Yeah.
Don't tell me who you are, just show me your portfolio. And I look at portfolio and I'm like, okay, this is interesting, because it's not the typical stuff that you see in most portfolios. The geography is all over the place, and you're like, okay, it's not like the top companies in each country. It's specific and not the typical companies. So I was intrigued right there from the beginning. I didn't know your strategy, obviously, you just explained it. And even though this is not how I do my investing, but I couldn't just appreciate what you just said, which is like a different point of view from a different investor from a different part of the world. But I also found, because I talked with a couple of Australian guys at the summit, maybe it was just Rhys Adams. His portfolio also is heavy on China. So I believe it had something to do with being closer to that geography, because we are in Europe and we are more comfortable investing in Europe and maybe in the US. But if you are in Southeast Asia or Australia, maybe you're more comfortable. I don't know if that has something to do with it or if that plays a role into your decision making. But I was curious to know how your selection process goes about. Is it purely on numbers, or it has to be an element of familiarity with the companies? Of course, crypto is it's all over the world, so it doesn't matter where you are for crypto. You can do it from wherever. But when it comes to companies, what is your selection process looks like?
So for me, and I'm looking again. I told you about convexity. I'm looking at convexity wherever I can find it. I know the impression is that because I'm Singaporean, because I'm Chinese, and I'm living in Australia, it's perfect. I understand the Chinese market, I understand culture. But I will tell you, I have bought Russian companies I can't even pronounce the name of, and I would be very comfortable. Very comfortable. So you mentioned China just now, so maybe I'll get into it. It's the reason why you look at the stocks in my portfolio. They're Chinese stocks, but you never heard of them. They're all red chip stocks. A majority of them are called red chip stocks. Red chip stocks are majority owned by this, the CCP, right, the Communist Party. So the reason why I bought those is because in Asian culture or Chinese culture, you cannot allow this. Well, we call it face, 面子. You cannot allow certain companies to fail or do badly because it's kind of government owned. And so it's not going to go to zero. You also know it's not going to do badly. And I looked at these and I said, okay, downside is quite limited because these are government owned. They'll probably follow the trajectory of how the Chinese economy is doing. And at the time when I bought, I started with 3323, which is China Building Materials. It did badly. It lost 40% or whatever. And it was just because of the sentiment that was in Europe and US. Everyone hated China. Everybody hated China. But the sentiment is so far off on one side, it didn't make sense at all. So I believe you had this topic. I was listening before I came on this podcast. We talked about efficient market hypothesis. And efficient market hypothesis says that, is the market always right, or is the market, has it factored in all the information? If you take the other side of that efficient market hypothesis, which is not academic at all, and you look at the way that George Soros trades, And his came from Popper, right? So his mentor is Popper. He says that the market is always in flux and it's not correct at any one point of time. It's always going up, it's always going down. You're trying to find the extreme positioning, whether it's extreme up or extreme down, and trying to ride that wave back to mean reversion or ride it back to a more logical place. And this is the concept of reflexivity. So if you read George Soros' book, Alchemy of Finance, you'll find these concepts. So for me, when I looked at China at the time, you know that these stocks aren't going to fail. They're not going to go zero. They're not going to go back to what they were like in 2021. So where's the correct number? And everybody was saying zero. If you look at the short squeeze that we had last week, and let's call it what it is, like people say stimulus and all that, they launched stimulus programs before, but this one was received very differently. And it looked like a short squeeze to me. And I tell you why. Last week was a holiday in China. It's called the Golden Week. So 1 week, no one is around from the Chinese market. So A shares, which are based in Shenzhen and Shanghai, they were closed. Only shares that were trading were H shares, which are Hong Kong-based shares. In Hong Kong, when that's open, the stocks were flying. And I expected when Monday rolled around, I expected all the Chinese investors to actually come in, and they didn't. And on Tuesday, the market just tanked. So when I look at that, I'm like, okay, this was really funds flow from US investors and European investors back into China. And it's not really kind of what do you call it? It's not an effect of the retail investors in China or the institutions in China going after the stock market. So when I look at that, I'm like, okay, that's a very strange thing. Not strange, but it happens in the market. And how do you read that? It's a very challenging question. But sorry, so back to the thesis, right? So the thesis is it's not going to go to zero. And at the time, a lot of these stocks were paying 5 to 6% dividend. If you look at China Railway, it was trading at a price multiple of 3. Price PE ratio of 3. If you look at Amazon, it's like 24. Tesla is like 50 or Nvidia is 50. You're 3. It's probably not going to trade at 15 and you're not going to get like 5x, but it's not 3. 3 is not the right number. So the question is, what's the right number? And everyone was so far on one side of the boat that trade became very, very obvious. So it doesn't, to me, geography doesn't matter as much as valuations.
Yeah, the valuations between US, Europe, and China, they're always going to be different. I don't see Chinese companies, even the really good ones, being at the valuations that the US are, because it's just a different mentality, a different investing philosophy between the two nations. So
let's touch on that. Like, why?
Yeah.
Let's touch on that. Why?
Because first, I'm not investing in China for the reasons, maybe it's my ignorance, but I give my case. So based on what I know, the Chinese people, I prefer to invest in real estate rather than.
Okay, let's not talk about China. Let's talk about I don't know, what's an interesting place. Let's talk about the difference between valuations in Luxembourg and US. Let's have that conversation. Is that a company that's kind of similar, that's based in Luxembourg? There you go.
I think it would be easier to pick German stocks because
Okay, let's
the
choose a
stock
German
market is
stock.
just bigger there to compare with the US. I mean, German stocks are trading quite cheap compared to the US ones.
Yeah.
I think it has to do a little bit with, I mean, we know that the S&P 500 has been outperforming for decades. Most of it's in the top 25%. So only the Scandinavian stock exchanges have performed better. Stock indices have performed better than the S&P 500. So personally, for example, me being based in Luxembourg, and I mean, I see Germany from my window. The logical step would be to buy German stocks because they're cheap. I know them. I do have some German stocks, but when I see at the performance, when I see where most of the world's money goes into, they go into US stocks. since decades. And so my retirement account actually is mostly US stocks. I'm not talking about eToro. It's really my retirement account. It's US stocks and Nordic stocks. So Norway, Sweden, Denmark, those tend to perform really good. And that's why the valuation is lower here in Germany, because the growth just, I think it has to do also a lot with the market sentiment. You just feel like the US has more innovation capability. There's more, everything is being created in the US, while in Europe it comes after the US. When there's a new innovation, it starts in the US, it expands there, and then it comes to Europe. And our first reflex is to try to regulate it and not to innovate further here in Europe. That's a little bit the mindset. It's also a little bit older. The consumer has older reflexes than the US consumer. The US consumer almost immediately adopts new technologies, while here in Europe, a lot of people still use checks. You know, those papers where you just yesterday I was in the office, and my colleague, he's like 26-year-old. He's Italian. He moved to Luxembourg, and he was like, "God damn it! The administration gave me those two checks. I don't even know what I'm supposed to do with them." But I have Revolut. It's an online bank. What am I supposed to do with those checks? How can I get the money from those piece of paper? So I think it has a lot to do with that also. So that's a bit the subjective part of the valuations.
And
Yeah,
also,
Demetris, what do you think? Yeah, you have LVMH, right?
yeah, that's the only one. That's the only one I have in Europe, and that's for the history and for the barriers of entry to enter into luxury goods. It's almost impossible. And by the time you start, they're gonna buy you out anyway.
Yeah.
But when it comes to valuations, usually tech gets the higher valuations, and Europe did not participated in the last 20 years into tech. They don't have technology in Europe. They only have luxury goods, and basically Europe, let's call it what it is. It's just an old museum. You go there to see the Colosseum and you see the Eiffel Tower. Let's call it what it is. China, on the other hand, participated to the tech revolution, you know, with the EVs and with AI, but still, in my opinion, is not their valuations, even they're not going to get as high in the US, and there are fundamental reasons for that, in my opinion. And that's why the valuations are different from continent to continent. It's not because they are not good companies. It's because the fundamental factors are not there for them to run. And besides that, in the US, financial services is 25% of the GDP. So the stock market is a big business in the US. A lot of people, that's what they do. In China's not there yet. The real estate is their thing. So eventually, maybe 10, 20 years into the future, when they say, you know what, let's try the stock market thing, and it's not being so heavy into real estate, maybe we'll get there. But
actually, you made a really good point, Dimitri, actually, about this. You know, in Europe, we also like very much to invest in real estate because it's something where we can live in. And in general, there's some kind of lack of trust from people living in Europe. They feel like the stock market is more like a casino, while in the US, most of the retirement accounts depend on the S&P. That's why you have higher valuation. Every month you receive a salary, a portion of it goes into your retirement account in the US. While here in Europe, the retirements are guaranteed by the state. You know that you can work 40 years, and then you know, after the 40 years you can retire. I personally decided to set up my personal retirement account because I don't know if 40 years from now the current youth will still be, I mean, the new youth, the new generation will be really working hard and agreeing to pay my retirement. You know, I mean, just a way to hedge potential mindset switch in the new generation. And that's also why real estate is feels safer here in Europe than investing in the stock market. That feels a bit like a casino. People like here to have a really predictable pattern, and they
Mhm.
know they're going to have that retirement when they're 60 or 65 years old, or in some countries already 70. So I think that plays a lot on the valuation, right? If every month you have all the retail investors, but also the accredited investors, money going into US ETFs, US indices, US stocks. So that automatically plays on the valuation. So Zach, a question to you actually. You're
Yeah.
saying, you
So
mentioned,
let me follow up on that. Let me follow up on that
yeah,
because I find this an
go ahead,
interesting
go ahead,
topic.
go ahead.
I love this topic. So you guys mentioned really, really good points. Culture is really important. The way that your financial system is structured is very important. Something Demetris brought up is very important. Tech is very important. So the question of these two are why, right? So if you look at Europe's returns versus the US returns from 1940s to about 2010, who do you think outperformed? Just off the basis, like just off the top of your head, what do you think?
You mean compare Europe from the 1940s?
Yes, to US in to
US?
2010.
I never looked the number, but I'm guessing it should be Europe because they rebuilt it so fast after the World War II. Was that what happened?
It's about flat. It's about the same.
Yeah.
So something happened from 2010 to 2024 that allowed US to really take over, right? And I take no credit for the research on this. If you guys are interested in this, Mike Green is one of the best people to look at. He's done so much research on this. The retirement savings accounts, or the Roth IRAs in the US, started to allow tax deductions for the regular person working, yeah? So now if you contribute to that, you get tax deductions. And a lot of that goes into passive investing. So what that does is, if you think about it, the SPDR or SPX or whatever ETF you buy is a very simple algorithm. I give you money, I will buy the index. You ask for money, I will sell the index, and that's all it is. And what has happened, and I find very scary, and why I'll never invest in an index, especially now, is because all indexes are built on a market cap weighted basis. So the bigger companies will always get bigger. Now, you have this system where every month someone's just putting in money, doesn't care about valuation, doesn't give a shit about anything, just puts in money. And now the bigger companies are getting bigger and bigger. What happens when the music stops and people start withdrawing from that? That becomes a very scary question. On the second part about tech, and I made this comment before, if you look at any sector in the S&P 500, like in the 1940s, it was railways. In 1980s and 1990s, it was banks. And later it was tech, right? All these are great revolutions to increasing productivity, which helps your GDP grow. But those things that did well in 10 years, in the next 10 years did not do well. Usually it's because of regulations to get broken. Banks, you guys know there was so much going on. There was a lot of theft and insider trading and things like that. So that got broken up. Now
So
banks are trading it.
what you're basically saying, based on the past decade, is that now is the end of big US tech.
No,
That's what
I
you're
don't
saying,
say that
between
at
the
all.
lines, right? Because it's what performed the best in the last 10 years. In the next 10 years, it will likely underperform or not. Or you think it's a much longer term kind of theme here?
So so I will never invest in the index because I know it's a time bomb. But as John Maynard Keynes said, right, the markets can stay irrational longer than you can stay solvent. So will I ever short that? No, never. I don't know how long this is going to go on for. And that's the scary part for me. Like, how do you hedge against retirement savings suddenly going up? It's very hard. And if you guys study the way that the market is constructed, there's something called gamma flip. So when gamma flip happens, the market dives, it will dive faster and fall faster than it's come up. Like, that's why they say the market is a escalator and then there's a lift coming down. So there's a lot of factors that make the market a certain way. Nassim Taleb calls it anti-fragile. Right? It's developed a certain way and it's constructed a certain way. But you see the risk. You see it from afar. you just don't know how long that music's going to keep going and when it's going to stop. I will never invest in the index for that reason. Doesn't mean it can't keep going. I've been saying that tech has been overvalued for, I think, since I started on eToro. And I've not really invested in tech since. But at the same time, it's gone. It keeps going. Like, what are you going to do? At first, it was like, oh, the tech sector is going to take over, right? And eventually, because of the way the market cap weighting goes, it became the Mac 7. And at the start of this year, it was really Mac 3. It was NVIDIA. It was, I can't remember the other two. I think it was Alphabet and Apple. They were just pulling the market up. So either you rotate and everybody like kind of evens out and the market goes up, which is possible, or, what I'm saying in that is that the Mac 7 will underperform, or there's a rotation, which is possible. But at the same time, I see the risk and therefore I want to invest in it. If you work at an institution, you work at a fund, you can hedge it. You can buy options, you can buy futures. To hedge it, you can become what we call long short. Like if you guys know long short, the average long short fund is 300% leverage because they can access leverage. On eToro, we can't. We have the ability to short and it's free, but your implied leverage at max is 1.6. So that's not enough to run a long short fund. So I don't think that's going to create enough alpha for you.
Dimitri, I would expect you to shout here because you have almost every of the Mag 7 and it's the core of your portfolio.
No, I'm not gonna. I mean, I am gonna shout, but not because I disagree. It's because I have like. So first, So I get what you say about the ETFs, and it makes more sense to be invested in the equal weighted than the way it is now that the larger companies get the large.
Oh no, definitely not.
Definitely not. Okay, I'm not investing in ETFs either. So I'm just trying to understand if you prefer the equal weighted. As for tech, because I'm invested in not all of them. I think five of the 7. And the reason is, so it was always have been tech that outperformed in the markets, not in the last 2 decades, but since the early 1900s. The companies that, the best railroad companies that entered the stock market, it was the more technological advanced companies enter the stock market. The same with the banks. The big banks that had more technology at the same. Now we have the technology in our head as the software, as what NVIDIA and what Microsoft does. But at some point, for a company to be listed in the stock market, it has to have an edge, and the edge was technology in some way or another. So technology was always valuated higher than the rest of them. Now we are at a different level, obviously. The valuations of some of the companies, NVIDIA, for example. NVIDIA, for example, if you just being a rational person, you can justify the high numbers, the high valuations, but also if you refuse to invest in them for the last 15, 20 years as a US investor, you probably missed all the returns provided by the market in the last 20 years. So it's basically, are you willing to take a leap of faith and buy it, and hopefully the valuation, and hopefully it's going to grow further and maybe sell to the next guy? Or do you really believe in them, that they're going to provide the future? That's the idea of tech and the valuations. In Europe, they don't have that because they don't have any tech companies. In China, I'm sure they are, but I'm not investing in China, so I can't speak about China because I'm not investing there. I stay in my lane. So, and in the US, because I was in the US for 10 years, and I understand how the culture is in the US, and it's much different than Europe, and I'm sure it's different than China as well. The winners are going to run until the next guy, until the next winner comes in, and you see who is getting killed. In that case, a major company that a lot of people have invested, but the index is going to come handy at the right time, and it's going to include the new winner and exclude the past winner. So if you are invested in the index, you're not going to feel it. But then you invested in the individual stocks and you are not properly diversified, and you have 20% on Nvidia, then you might get killed. I don't know if I'm answering your question or I'm making a point. I'm just talking like I have subjects in my head trying to respond.
No. It's great. It's great. This is how we learn. Yeah.
But I see your point. I'm not disagreeing with you. I just see a different opinion on it. Because sometimes it's not just, I don't have to agree or disagree with you. I can hear you out. Then I can tell you that the way I see it, and is what a conversation is basically.
No, 100%. So I'll respond with two things, right? So I don't know I don't have education background for both of you, but one of the fundamental models that you learn growing up in finance, right, is the Farmer French model. So it's a Nobel Prize winning model, right? And what does the Farmer French say? It says that small outperforms big, value outperforms growth. If you bought the Farmer French model for the last 10 years, you would have been slaughtered, absolutely destroyed. Because you are 100% correct. The market did not agree with the model and just like blew it out of the water. So when I invest, again, the reason why I don't invest in Mag 7 is not because I don't agree with it, that it can keep going. It's because now my convexity is different. Like I mentioned just now, what I'm really looking for is convexity. What's my upside? What's my downside? That's basically it. When it comes to the Mag 7, you're basically depending on spread compression and continued growth. Can I depend on that going into the next 2 or 3 years? I think it's very hard. It's too hard for me. So I'd rather invest in something where that risk is more defined. It's not that I disagree with you. The music can keep going, tech can keep performing. But are there better bets that make it easier for us as investors to make money and lose less when shit hits the fan? So my belief is there is. And that's why I invest in those stocks that you guys see. It's all over the place. And it's very strange.
In the case of Chinese stocks, you mentioned you invest in the ones where the CCP is invested, because there you know the downside risk is very limited. It's not going to go to zero.
Exactly.
But we haven't talked that much about the upside part of it. What upside do you see in Alibaba or China National Building, or you know, in those companies, in the ones you pick? How do you not individually, but how do you, what's your methodology to assess the upside of the stocks in your screening process?
Discounted cash flow. Simple discounted cash flow.
Okay.
So discounted cash flow is a finance concept that we say what happens if we take the future earnings of a company, we assume a growth, and we discount it back by our required return. So when I do discounted cash flow models, I am absolutely brutal. I assume zero growth for the next 10 years, and I assume 20% return. If I cannot get that, I will not buy a stock based on valuations. There are other reasons I may buy a stock, but when it comes to this, I'm absolutely brutal. Nobody in their right mind does these kind of valuations. But I do it because I think that being active, being able to switch between different industries, gives you the ability to find those high upside valuations.
So do you see companies in and I'm not meaning anything, but what I'm going to say, do you see companies in a more superficial way? Like to you it's just numbers, and if the numbers make sense, I mean, if the numbers don't make sense, I'm out. And then you look the bigger picture of in whatever country they are, whatever is going on in the country, and politics, geopolitics, energy, all that. Are those coming like are those questions coming later? First, the numbers have to make sense. Your valuation metrics, whatever you're choosing to evaluate them, those have to be first, and then everything else comes second. Is that
so the question is whether you're using a bottom-up approach, essentially.
No, it's a good question. Let's see.
You know, on eToro, when we see your holding
Yeah.
time period, right? It's complementary. But I don't know if it's I mean, you know, it's written that you hold on average for 8 months
Mhm.
your stocks. I don't know if it's just because you slightly rebalance and that affects the the statistics, but um, it seems like you look at the numbers and then when it doesn't fit anymore, the model, you just get rid of the stock and then you get another that fits with the 0% growth, 20% required return in the DCF model, right? So
Mhm.
is that how you proceed, or are we summarizing it a bit too much here?
No, it's good. It's good. It's on the right track. So do I view the industry as important? I would say yes. The reason is if it's cheap, it's usually cheap for a reason. I think you should Shafiq may have mentioned it like during this podcast with you guys. If it's cheap for a reason. So the question is, why is it cheap? So if it's cheap because of an illogical reason, then I will buy it. If it's cheap because of a logical reason, I may not buy it. So a great example is like Paramount. Paramount Group, I just bought the REIT, right? But Paramount itself as a TV company, do I have a view on that? Zero view. So I can't buy. But if it's something that's cheap for a logical reason, like one of the holdings I had at the beginning of the year was PHIN, which I sold. It was cheap because it was a spin-off from a different company. And because of requirements of market cap size, a lot
Yeah.
of institutions were forced to sell. So then you had a logical seller and you had no buyers. And the buyers happened to be management. The management team saw their own stock and like, oh, that's cheap, so I'm buying it. So that's why I bought it. It was cheap for a reason.
You know what? It's so interesting because um, a lot of investors, they want to get ideological about investing. My way, it's better than your way. Instead of, I don't care how you get there, just get there, just get the good returns. I don't care how you do it, just do it. If you do it differently than me, then fine. So I'm not criticizing, I'm just asking, so I'm trying to understand exactly what you do, because if I can learn something from this podcast, then I leave the podcast and I'm happy, because if I learn one thing and I become better, then I'm happy. That's why we started the podcast, so we can talk to other investors
Yeah.
and seek for their insights, maybe in geography, maybe in strategy, maybe in whatever the case may be. So that's why I was asking if you're just a bottom-up kind of investor, which is fine. I mean, your returns justified what you do, what you did, and what you're doing. So there's no issue with that. But I want to ask you one more thing about. Do you have a
No,
favorite?
but it's a good point. I do want to touch on that. So
Yeah, go ahead.
I remember at the start of this podcast, I said my objective has always been, how do you help retail investors? How do you do better than what the institutions are doing? And the challenge for us PIs is very large. We have to manage a portfolio, somehow beat the market with less resources than the average institution, with less time because we're doing it part-time. So our strategy has to be absolutely impeccable for us to even accomplish this task. It's very difficult. So now when you look at that, you're like, okay, if I'm a value investor, and I say ideologically, I am a value investor, are there periods of time where value has not done well in the market? Yes, absolutely. It has lost to growth. Like we just mentioned, Pharma French model, who got blown out. So being ideological doesn't work. And if you say you're ideological about investing in like just pure US, is that an advantage or disadvantage to you? Isn't it a disadvantage because the market is so big? So you have to use whatever advantages you get, because our task is very, very difficult. What we're trying to do is very, very difficult. And therefore, I developed this strategy because I'm like, I want to help people as much as I can. And I'm sharing this openly with you guys because I think it's something that I want people on eToro to do. I think we have the opportunity here to become huge. I honestly believe that eToro has an opportunity to manage a lot of money, because we've fallen into this trap of, let's do passive investing. In the selfish gene, you think about it, who wins? It's always humans, because we adapt. And now we're feeding people this blind strategy. I give you money, you buy. I take away money, you sell. That's it. Can we beat a simple algorithm? We should be able to beat a simple algorithm.
Yeah, it's interesting. People want to put themselves in a category. They want to belong to a team. I'm a value investor, I'm a growth investor, I'm this and that. Yeah, instead of how do I pick the good spot from this strategy and come up with my own so I can beat.
Exactly.
So I agree with you on that. And that's why I started in investing on eToro. And prior to eToro, I just wanted to manage my own money. And I wanted to do if I can do better than the market. Okay, the market does what it does, but can I do better? And somewhere along the way, I knew, okay, I can't beat the market, so why would I invest in the market? Let me pick the stocks. Let me do the work. And by talking to people, and by the way, that those two last summits that we attended on eToro, it helped me a lot talking with other people, because if you were at the London summit, we'll probably have this conversation in person right there without any camera.
Yeah.
So we're having the conversation that we will have anyway in person. So you talk with other people and you see, okay, maybe he sees something I don't see. Let me hear. You don't have to be ideological about investing. There's no reason to. And we all want to do the best we can, and at the same time provide good returns for our copiers. So the bottom line is this: if you can do a better way than just
no, 100%.
It's a great bottom line, actually, Dimitri. As you mentioned at the Popular Investor Summit in London, everyone has a different strategy, but like really, 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 there's so many different strategies, and they all perform. I mean, not all of them, but there's many, many of them that perform really good, which shows that there's no one way to do it, right?
there are many
Can
ways.
we agree on?
There are many ways to do it, actually, and each person has its way. And I'm going back to Zach. When I looked his portfolio for the first time, like sometimes you can see the portfolio and you can picture, okay, this guy's from Europe. Okay, this guy. When I looked at your portfolio, I couldn't guess where you're from. I could not guess you were Australian, because it was like all over the place, and not the typical companies that you watch in CNBC and just buying them. It was like a second level kind of companies, not the obvious names. So that's why I was so intrigued talking to you. And now that you explained your way of doing it, it makes even more sense. It makes even more sense now than before. So thank you for explaining.
No, I really don't want to share this because we have a chance, right? I don't see a problem eToro managing have like 10, 20 black stars. I don't see a problem. There's so much money out there. There's so much money to go around. And we can do it better than our algorithm. It's just, how do you do it? The strategy is so important to me. And even when I started this, I asked myself the question, if I were to put myself in any timeline in the last 20, 30 years, and I wanted to perform at any point of time, it doesn't matter when, how would I do it? But then you look at how professional investors do it, and then you derive a strategy from there. And that's how I figured out how to do this. This is not like a marketing gig or a gimmick or some shit like that. I'm really trying to like optimize for the tools that we have. Because like I said, we have very little time, we have very little resources, and we have very blunt tools. We only can buy or sell. Like we don't have derivatives, and I don't know we should, because it's very complicated. But yeah, that's kind of how it's been.
Akim, you have a point? You have a question for Zach? And we have him here now, so you better ask the questions you want to ask him.
No, I think we did a very nice, we had a very nice conversation around a lot of points. I actually feel really happy to have Zach. I was looking at the statistics that were shared at the Popular Investor Summit. There are 11 elite pros at the moment. 93 elite, but 11 elite pro, and to have one of the I think it's actually the second one from the 11. The first one was Pietari. He joined our call, and
Oh yeah.
honestly, it was very, again, really quality conversation. But we had also very, very interesting discussions with other guests as well about their strategies. But getting to learn Zach is something that is quite interesting, because the portfolio is really is exotic. For some people, you manage to understand immediately. For example, when you look Demetris' portfolio and you see big US stocks, you know that the guy must have lived in the US,
Yeah.
follows US news,
Yeah.
or at least is betting for America, right? And then when we see your portfolio, Zach, it's quite something. You have a German stock, you have one headquartered in Luxembourg as your third biggest position, you have Chinese stocks, you have crypto, you're trading currencies as well.
Yeah. That's a
So
carry trade.
it's
Yeah.
a carry trade.
Yeah.
That's quite interesting, honestly, the bottom up approach that we discussed.
And now that you said we have Mariano as well, the
Yeah.
And Mariano, that's true. He's also elite pro.
Populaware. So from out of the three elite pros, they are all completely different, right?
Completely different.
Completely
Definitely.
different.
There is
So
nothing in common. Not even, I'm sure there's not even a single asset shared
yes,
between the three
completely
portfolios,
one.
and the three of them perform really good,
Yes.
right?
So if that's not a proof that it can be done different ways, and you can get good results in doing it the different ways, then I don't know what is. If
Exactly.
the three
Yeah.
top guys that we have on the podcast do it completely different, but they get there, then I rest my case.
Yeah.
Think, yeah. Zach, do you have one maybe final tip for a new investor who registers on eToro and he has money and he or she doesn't know what to do and feels a little bit lost? Do you have a tip here on how he or she can make money in the long run, except by copying you, of course? We will add a link to your
Yeah.
portfolio in the description of the episode, so people can go and check and follow, copy. But do you have any tip? Maybe start by reading all those models that you mentioned, or how would you start as an investor?
If someone was starting, like just starting out, I would say it's a difficult game. If you want to play, know that there is. There are pros every day out there doing this for a living. I am one of them, not just in eToro, but on my actual job. Akim is also the portfolio manager. He does some of this. It is a difficult game. If you want to beat the market, you want to beat other managers, there are certain things you need to be wary of. And if you listen to anybody at all, I just ask you to do one thing: verify their results. If you YouTube anybody, just verify their results. That's the only thing that I ask of you. And the reason why is actually I developed a blockchain project because I was sick of all these like YouTube influencers. And it verified anybody's accounts, whether you're Robinhood or Interactive Brokers, it doesn't matter. I can go into your account and verify your results. I approached 200 of the biggest influencers on YouTube. One person replied me and he wanted to be paid. This game
That's
is difficult.
the editor-in-chief of eToro. His name is Mati Alon. Maybe you know him, Zach.
Yes, I've spoken to him.
He always says, don't just talk the talk, but walk the walk as well. So I think it's a good way to conclude this episode. Thanks a lot, Zach, for joining. It was really a fantastic conversation we had. We will put the link to your portfolio in the description of the episode, so people can feel free to reach out. To follow your portfolio, and they can also reach out in the comment section if there are any questions. We will forward them to Zach. So thanks a lot, and guys, see you next time.
Thank you, Zach. Thank you for your time. And we're gonna talk in person at the next summit.
Yeah. Yes, let's do that.
All right.
All right. Bye-bye.
All right. Bye.